Hello and welcome to an episode of the Student Loan Planner Podcast. It's Travis, and today we're going to talk about tax-free forgiveness strategies. Who doesn't love that? We're going to talk about PSLF. We're going to talk about ways to get your tax bomb potentially not charged if you're going for the taxable version of loan forgiveness, right? And we're going to talk about the predicament people are in that are hoping to get their loans forgiven this year because there's some unique treatment going on with taxes if you qualify for forgiveness this year but don't get it until future years. So before we jump into that idea, I thought maybe we would just take a few listener questions. It's been a little bit since we've done that. So let's listen into this first question from Jay.
Hello, Travis. First off, huge thanks to you and the Student Loan Planner team. There's no better resource out there. I have a question about lump sum payments for individuals seeking public service loan forgiveness. My question also maybe touches on refunds of loan payments. My general understanding is that a lump sum payment for someone seeking public service loan forgiveness can be allocated for future monthly payments for up to 12 months. Until recently, I was on the SAVE plan in forbearance due to the court injunction. During the forbearance period, my employer, the federal government, made a lump sum payment to my servicer on my behalf. This payment was basically an award or a grant that was going to cover almost a year of my PSLF payments. Shortly after that payment was made, I contacted my servicer, and the servicer reassured me I could allocate that lump sum payment to get multiple months PSLF credit as soon as I was out of the SAVE forbearance. I'm now out of the SAVE forbearance on the pay plan, which I switched into about a couple months ago. I recently called my servicer and attempted to allocate my lump sum payment going forward. And the servicer told me that now my lump sum payment could not go to future PSLF payments. The rationale the servicer provided is that I'm no longer on the same plan I was on at the time of the lump sum payment. Now I have a new plan, the pay plan, with new disclosures, which prevent me from allocating money that was paid when I was on the SAVE plan. The servicer also kind of acknowledged how much of a predicament I was in and encouraged me to submit a complaint to the ombudsman group, which I did. Still waiting for a response there. Servicer also told me that I could not have the lump sum refunded to me, only to my employer who made the payment. And I know if that happens, I probably won't see the money ever again. I'm curious, first, do you see a way for me to get multiple months PSLF credit for that lump sum payment when I was in the SAVE forbearance? Second, do you have any suggestions besides contacting the ombudsman group? Third, do you think the ombudsman group could even help me with this sort of situation? Fourth, if I cannot get PSLF credit for that lump sum payment, do you think there's any way I could convince the servicer to refund the payment to me instead of my employer? I'm only about a year away from PSLF forgiveness, and this lump sum payment would cover roughly 10 of my next 12 months of payments. So it's pretty important to me to figure this out. Thanks so much for your advice and your expertise.
All right. So what it used to be is that you needed to make your PSLF payment right after your IDR recertification date, ideally, to have it count for up to 12 months of credit. That's the way it used to be in the past. What it sounds like is the servicers are dealing with a government that was shut down for many, many weeks that also is published resources on PSLF regulations, which are in a separate set of regulations than the IDR regulations. And also the SAVE plan is under injunction, and they just don't know what the heck to do. So I do think in this kind of situation, it is extremely muddy as to what exactly the right thing that was supposed to happen, and that's why they messed it up. So I would definitely say reach out to the ombudsman, but I don't think that's enough. I think that you would, well, first of all, FSA complaint, you submit the FSA complaint, wait a couple weeks, see if anything happens. If it doesn't, CFPB is pretty much dead. So then I would reach out to, your senators and or congressperson and do a constituent services request. So essentially, you would just reach out and say something to the order of, hey, I'm a federal government employee. I was given this award. It was supposed to cover some of my income-based repayments, and my servicer's not doing anything. They're saying that they don't know what to do, and I'm at loss for words as well. So I think that I would go ahead and try to file complaints with everybody. When there's a really screwed up situation, the more people you tell about it, the better. The more you escalate it, the better. The only cost is a quick email of your time. So I would do that. And then for anybody who is listening to this thinking, oh my gosh, how disgusting that, You have to navigate whether or not you even get a benefit from this employer provided, lump sum payment to your servicer. I mean, that's because it wasn't designed this way. Forgiveness was never, thought through as something that employers making lump sums would need to think about. And so it wasn't thought through. And so, as the user, as the end user, what I kind of recommend is whenever your employer wants to get involved with your student loans and make a payment, you better make darn sure that your life decisions are in no way being influenced by whatever your employer is doing. Why do I say this? Because ultimately, employers provide student loan repayment assistance for one reason and one reason only. They think it's cheaper than paying you the same amount in salary. And they want you to overvalue that benefit and they want you to stick around for a long period of time at that employer. And they hope that you don't require salary, that you'll request the employer student loan assistance, instead. That's one thought about this. The other thought about it is sometimes these benefits can be taxable. It depends on the situation, but sometimes this can actually end up being taxable income. It can push your, AGI higher, right? Where you don't qualify for as many deductions, potentially with the SALT tax deduction phasing out at 500K, starting to phase out at 500K of AGI if you're married. There can be negative impacts to you as a taxpayer for having a bunch of taxable income that doesn't even help you all that much. So, I mean, just remember just one random example that I did when I was doing more consults. I had this dentist couple that were married, and they were both driving 2 hours, away from each other during the course of the workday. So one was driving 2 hours north, one drive was driving 2 hours south. It might have been an hour, right? I don't remember the exact number, but it was a really large number that they were both stuck in traffic for there and back. And they were doing that because they were both trying to get an FQHC to get 20,000, 25,000 a year of loan forgiveness or something like that. And I was like, guys, you both have 400, 500K of loans. Do y'all realize that you're both going for pay as you earn or IBR forgiveness anyway? This lump sum benefit that you're trying to get is effectively worthless. And that was really hard for them to hear. I understand why. That was pretty shocking, pretty hard to hear that you've been driving in this is in the north. So the icy roads, like huge commutes every single day when they didn't need to, right? But that's why we exist, is to prevent people from doing things with their lives that would hurt their life quality or their quality of life. And you're doing it for no reason, no benefit to you. So for this person, don't bang your head against the wall, escalate it everywhere, see what happens. And I'm sorry you're going through this. Let's take another listener question.
Hi, Travis. I am not sure of my next steps in planning for student loan repayment. I work as an acupuncturist and musician for a living, but there are a few jobs, and these jobs don't have benefits and are 1099. I'm on pay with 100% of loans from acupuncture school, and I'm 10 years in repayment. Currently, the balance is $230,000. I'm also 1 year in on waiting for a decision for borrower defense discharge, and I believe I have a strong case. My next recertification date is January 15th, 2026. I rely on the marketplace for health insurance coverage. I usually make around $60,000 to $65,000 a year after business deductions between the two careers, and I do not expect this to increase significantly in the future based on my work history. I recently separated from my husband because of his refusal to work or be stable in work the last couple years, along with other mental health issues. And yes, I have seen a lawyer, and yes, we have tried couples counseling in the past, including discussing these issues. He says he is still committed to the marriage but wants to file separately from now on. He only told me this now, so it means that my traditional IRA will not count as a deduction for AGI, and I already funded that early in the year. We also had some unexpected medical expenses this year I had to cover, as well as travel for my dad's illness, terminal illness, and his family, my husband's family, who suffered losses from hurricane damage, and then my recent move out. So my solo 401k is not funded well this year. However, since I moved out, he has since gotten a job offer. He actually got his dream job offer, and he will be working for state government with excellent benefits, and said he could get me on his insurance as of January 1st, 2026. I love my husband a lot, and I'm open to continuing the relationship, but I am not sure I feel good about being legally married still and subject to the laws that exist as of now. I'd love to get some feedback on how it affects my student loans since I know that sometimes it's recommended to do married filing separately, and perhaps understanding it more could set me at ease and let me make a more informed decision, both financially and about the relationship. Love your podcast and all of the information you've put out there. Thank you so much for considering my question.
Thank you so much for this person being vulnerable. Obviously, we're not mentioning any names because of the sensitivity of that situation. But I just want to say thank you for listening to the podcast. When we did this big survey of incomes for different professions, acupuncturists had it the roughest of anybody. Acupuncturist had, I think a 3.3 to 1 debt to income ratio. There's a several list of schools that somehow got the ability to borrow unlimited loans that were basically not telling the truth about what the actual employment outcomes were going to be. And a lot of people that join those schools have really struggled. So I just want to acknowledge that. Now, we'll say this too before I mean, just if I'm going to be really honest about the situation, right? 60K of income is low for our professional audience listening, but it's not low in general, right? 60K of income for a lot of people is actually an excellent income. And so I think that what this person needs to do is just to sort of stop, take a look in the mirror, and think about what they want for their life. Do they love their job? If they love their job, then you want to just keep being an acupuncturist. So you need to figure it out. You're going to have to live in, frankly, a less attractive house than a lot of people would want to live in. You'd probably have to drive a less attractive car than a lot of people would want to drive, but you could make it work. Why? Because I mean, I don't know, my dad made about 40K a year as a teacher. My mom didn't work growing up, so we lived on a household income of 40K. It wasn't easy. It was stressful. Like there were constant coupon cuttings, constant, sorry, we can't do that. Sorry, we have to go out and share a meal with multiple people eating off the plate, so to speak. I mean, not being gross or anything, but it's just like, kids meal until you're 14, you don't get to order off the adult menu until you're very much past the kids meal, right? So I grew up kind of knowing a little bit of financial stress, and I one of the reasons I do this and keep coming back, even though this is a stressful business to be in with student loans, is because I love helping to remove financial stress from other people and create financial abundance for people. So I guess, but that's not answering this listener's question. So if I try to answer that question more directly, like married filing separately is fine. You can do married filing separately, have the payment based only off of your loans. If you're on pay, eventually you're going to have to get off of pay if they don't approve your borrower defense request, and your payment's going to go up about 50% because 10% of this pay as you earn. If you're on that, it's probably because you don't qualify for new IBR. So that means your payment is going to go up from where it is now about 50%. Assuming that you've been filing separately for a while. And in terms of health insurance, the big problem with married filing separate when you're on the ACA is you lose the premium assistance for the ACA. That is a big expense. Like you could be talking, depending on how expensive health insurance in your area is, if you're getting a $300 a month subsidy, that's $3,600 a year. That is wiped away when you file married filing separate. And, it just is. And so then the question would be, well, if you are married and you want to stay married, I mean, first of all, I would advocate for you to make whatever decisions with you in your relationship that you think are best for you, regardless of the money situation, right? Like think that should be the first and foremost. The listener said that she still loves her husband, so it sounds like this person is open to staying in the relationship. I would say that um, I'm not a marriage counselor, so I'm careful, I'm trying to be careful about what I say. But it seems like this person is heading in a better direction. I would encourage this person's husband that, hey, you're getting a job offer, you're responding to the things I asked you to do. Thank you. I mean, that might be hard to say depending on what she's experienced, and what this person has done in the relationship, but hopefully it's, being proud of this person. There's a good marriage book out there. Um, by John Gottman, I think his name is, called The Seven Principles of a Highly Effective Marriage or something like that. And one of the ones is fondness and admiration for each other. So one thing that's kind of tough in this relationship is like when somebody is not getting a job, they're not pulling their end of the bargain. It's hard to have fondness and admiration for somebody who is struggling with mental health issues and can't get a stable job, right? But now this person seems to be doing that. That's an example of the book would say, have fondness and admiration for that person because they are sort of fixing some of the things that have frustrated you. Um, I don't know. This is a tough one, so I guess I'm talking a little bit maybe too long. But in terms of the student loans, your payment on IBR will go up when you get switched to IBR. Definitely try out the borrower defense claim. Give it a try. It's worth it to give it a try. I've seen some people get some surprising claims approved sometimes. Um, and in terms of your life, like 60K income, health insurance, like if you can get on your health insurance for your husband's plan, that removes a big weight off your shoulders. And then the main thing about your finances is looking out for your housing and your car situation and making sure you're not overspending there. If you're being really careful with housing and cars, everything else is going to be pretty easy. If you're not being careful with housing and car expenses, things are going to be really tough. So, and then, the last thing I'd say is we are coming up on July 2026, where if you have not borrowed for at least one loan for a program before July 2026, you're subject to the old loan limits. So, I mean, I will just say this rather bluntly. If there's any ability that you have or interest you have in making more money, if that's a priority for you, you have a few more months to sign up for some sort of program like a PA program or a NP program. If that's even on the table, it might not be, and that's okay if it's not. Maybe physical therapy, right? Like there's programs out there that you could sign up for that you could take out Grad Plus for. And if you have 200K, it's like, well, what's another 200K? You're going to be going for IBR anyway, right? So if you have 400K of loans instead of 230K of loans, and you've got 120K income instead of a 60K income because you're a PA, that's a lot more stable existence. You're getting benefits. You're getting your own health insurance benefits. You're not having to be 1099. You have guaranteed employment with labor law protections, unemployment, being paid in. So, I mean, I think that there's a lot of things just to think about for this person. Do they want to remain an acupuncturist? Do they want to stay in their marriage? This is a really interesting question, and hopefully, I've given them some things to think about that maybe help you as a general listener too, to think through some of the things that you might be thinking about yourself and your own relationship and income level and such. So let's listen to another question.
Hi, Travis. Here's my Student Loan Planner podcast question. I have a question about refinancing or staying in my federal servicer, which is Advantage. I make $145,000 in gross income. I have $162,000 remaining on my student loans. I've paid down about $15,000 this year. We decided to pay off my loans as they are the only debt we have besides our mortgage, and they are under the 1.5% threshold of income to loan rationale. I'm currently doing the debt avalanche method and paying off the highest interest rate to lowest interest rate. The lowest interest rate is 3.6%, and the highest is 6.75%. The average interest rate of my loans, 11 loans remaining, are 5.73%. I'm currently on pay as you earn with a recertification date of August 8th, 2026. I believe it will take about 4 to 5 years to pay off even on our aggressive strategy. Do you think it is worth it to me to remain with a federal servicer to hold on to those federal protections? Or do you think we should refinance? Thanks.
All right, this is an interesting question because I just want to acknowledge my conflict of interest that when people refinance, we make money on that. At studentloanplanner.com/refi. When you go and visit that page, the way I try to mitigate that conflict of interest is by giving money back out of the commission we earn when somebody refinances. We try to have the best cash bonuses anywhere in the internet that we pay for out of what we make when somebody does refinance to mitigate that conflict of interest. But I just want to acknowledge that there is one, but I still think that I'm able to tackle this and what I would recommend to my own family members if I had somebody asking me this question. So, do I think that you should refinance? You've already sort of made that decision with paying 15,000 down. Not necessarily something that you're locked into, but by paying 15,000 down, you have already indicated that that's really what you want to do. And I'm presuming this person's in the private sector. And so they also talked about we, so that means they have their spouse's buy-in to this. That is exactly the kind of combination that's going to result in somebody having financial success in life, them and their spouse being on the same page, them committing to something financially and sticking with it, and then trying to come up with strategies for how do you get out of the debt and what's the best way to get out of it. And so listening to this person talk a little bit, I think because they mentioned also having different loans, that the strategy that I'd probably go down is refinancing the higher interest stuff into a big lump sum payment, maybe even a 20-year fixed rate. But what you can do is take all the stuff above 5%, put it into a 20-year fixed rate to give yourself payment flexibility, and then leave all the stuff behind that's 3.7, whatever. And the reason I would probably do that is then it doesn't really matter too much about avalanche versus snowball. I've built a calculator that looks at both methods. The funny thing is both of them have arguments, the avalanche method goes after the highest interest rate, but it doesn't get you payment relief as fast because you're just going after the highest interest rate, and your monthly payment that you're required to make stays the same until one of those loans is paid off. The reason why people advocate for the snowball method is because it brings required monthly payment relief quicker, and it allows you to breathe. And psychology is very important in paying down debt because it's like, gosh, I'd love for this money to be going to anything other than getting back to zero. But at the same time, like those psychological wins are going to be very motivating, and you're going to be more willing to make sacrifices on things like going out to eat, vacations, putting off house stuff. Like, that you're going to be more willing to make those sacrifices when you feel like you're making faster progress. So I think what I would probably do is I would refinance all the stuff over 5%. I do believe we have the best deals on the internet. If somebody finds a better deal somewhere else, please let me know about it because I don't think that that would be the case, that somebody else would be able to find a better deal than what they could find on our site. But go to studentloanplanner.com/refi, apply with at least the top 2, 3 lenders to see what you could get. And I think you're going to get something in the fours or the fives, and that's going to be cheaper than 6.7. And again, do the 20-year fixed or 15-year fixed to keep yourself low required payment. And then maybe consider doing you can either pay down the private loan aggressively and then refinance it again to our refinance ladder method, right? So remember, that's when you maybe start with like 150K, you pay some down, you refinance again when you get to 100, and you do a 10-year loan instead of 15 or 20, and that way it keeps the payment about the same, where you're not over committing to your required monthly payment. But I would also feel totally fine telling this person refinance, get like a 4.5 to 5% interest rate on the high interest stuff. And then for those 3-something rates, just pay them off, just get them done. Then your required payment's going to go down and you're going to feel a lot more easy. It's going to feel like you can breathe more easily. Is the dollar amount huge? No, not really. Like when you're talking about saving 3.7% interest versus 5, it's a 1.2% spread. It doesn't make a big difference either way, in terms of whatever gets you most motivated to pay it down, do that. So let's listen to another question.
Hello, student loan planner. I have had 2 consultations with your company in the past, and I wanted to start by thanking you for all of the support you've provided my husband and I over the course of paying for these student loans. This is my question. I have been approved for PSLF. I graduated in May 2015, and I had the 6-month grace period right after graduation. And then from December 2015 to April 2016, I put my loans into forbearance. I would like to buy back those 5 months, but when I called Department of Ed today, I was told that the loans are ineligible for buyback because they were in forbearance. And my question is that accurate? Are there types of forbearance that are not eligible for buyback?
What a great question. I mean, so I think that the main reason this person's not eligible yet is I think they said they graduated in 2015 and they had a 6-month grace period. And I'm thinking they're not at 120 months of total qualifying employment yet. So you have to be at 120 months of total qualifying employment first before you even submit your buyback inquiry. And if you do that before you're at the 120 months of qualifying employment, they're entitled to just not respond to you even, or just not say anything. I mean, that's kind of like what they're doing basically. So I think that the priority for this person needs to be go get all of your employment certified. Go to studentaid.gov/PSLF, make sure everything is on there, that they know about all of it, and then try to wait until you've reached 120 months of qualifying employment at a PSLF eligible employer, and then go back and try to buy back that period. It's hard to say. I mean, in some cases, if something was coded as an in-school deferment, it wouldn't be eligible at this point. But for forbearance, if it was truly forbearance, I don't see a reason as to why you shouldn't at least give it a shot. I mean, I think that the problem is like with the new administration, like a lot of these PSLF rules that were written by the Biden administration are subject to just being rewritten with very little, warning, and just undone whenever they want. And so it's sort of like when it's regulations and when it was done through negotiated rulemaking, and the Trump administration is currently doing negotiated rulemaking, the problem is if you go submit a complaint, if it goes to the Department of Ed ombudsman, that person's probably not getting a paycheck right now. They're not able to. I mean, maybe hopefully by the time this comes out, maybe the government's reopened, but people have not been getting paid, and they're trying to axe the Department of Ed. And it's sort of like, well, if you make a complaint to an empty void, does anybody do anything about it? I don't know. And that's kind of why I say escalate stuff, right? Get your senator or representative's constituent services office involved. And it's even better if they happen to be, somebody on the education committee or something like that, or somebody in a tight reelection race, because then their incentive to care goes up a lot. So I'm sorry that you're dealing with this. It's pretty frustrating, pretty difficult, but I will say, get to the 120 months of qualifying employment and then throw your hat in the ring with PSLF buyback and see what happens. Let's take one more.
Hi, Travis. I listened to your podcast about the negotiated rulemaking for PSLF and the likelihood of a lawsuit to challenge regulations. And now I'm wondering if you think it's likely also that an injunction would follow, any kind of lawsuit where the administration tries to reduce the employment that's eligible for PSLF. I asked because I would be eligible for PSLF in July 2026, and I'm worried that this would just kick the can down the road further for an unknown amount of time where no employment is certified because there's an injunction in place.
So first off, anything is possible. I do think that what you're seeing right now from like consumer advocacy groups is they're going and filing cases in more friendly jurisdictions whenever whenever the Trump administration does something, in the hopes that a district court judge or a appeals court panel is going to do an injunction, or at least force some sort of settlement or something like that to make some of these rules a little bit less intense. But I mean, will you see litigation after they file whatever the final version of the PSLF regs is? Will you see a legal action against it? Absolutely. What will happen? That's what I can't predict. In terms of being worried about this, I mean, I think that people need to realize that the Trump administration is not trying to strip PSLF access to all hospitals. They're not trying to strip PSLF access to, the majority of nonprofits, right? They're trying to use a cudgel to force compliance with what they believe is what the law should be. And so, think about an analogy is what they've done with higher education. What have they tried to do? They've tried to get, higher ed groups to sign on to pacts where they're going to agree to do certain things. And if they agree to those things, then they get preferred access to funding, right? Or something along those lines, right? And so it's a very similar kind of process where they're trying to use the power of the federal government to make sure that organizations fall in line with what they want those organizations to do and what they believe the law is. So does that mean you're going to see mass PSLF rejections? No, I don't think you will. I think you're going to see, ones that they want to go after and have appear in the evening news, so to speak, right? Like, so they're going to go after the most, the most strong advocacy organizations, the ones that have the clearest, anti-administration agenda. Those are the ones that I think they're going to go after. And then I think a lot of the hospital systems are just going to try to kind of not stay under the radar, basically, right? So I think that if I'm a physician at a not-for-profit hospital, I think I'm not super worried about this. I think if anything, let's hypothetically say, I mean, if I'm just going to throw out a really kind of blunt example, that a hospital system provides, let's just hypothetically say a hospital system doesn't cooperate with ICE or provides transgender care to minors or something like that, right? And then loses access to PSLF because of it. Do I think that that hospital will fight it? Maybe if you're one of the best resourced hospital systems in the country, sure, probably. But if you're one of these more out of the way kind of employers, or, you're trying to just keep operating and just not draw attention to yourself, you're probably just going to comply with whatever the administration's asking of you and move on. And so, what would be an example of a hospital system that could potentially be targeted? I mean, again, probably a big hospital system. It's very well resourced in a blue city and a blue state. So if you work at one of those sorts of organizations, I'm sorry for raising, any kind of concerns that you might have. I would not be concerned though until we've seen all the litigation come out, all the fighting that's going to happen about this occur. So I would just say deep breaths on this. Now I want to talk a little bit more positively about the tax-free loan forgiveness strategies just overall, writ large, right? So tax-free forgiveness strategies, there's some things you can do to get tax-free forgiveness. One of them is to get your employer to chip in money tax-free. I've talked about why you shouldn't overvalue that, but there are programs out there where employers can chip in some money tax-free to your loans. If you can get that, get it. If you're not, if that's, just make sure that it doesn't influence your career decisions, of course, like I've talked about. Now, for tax-free forgiveness in PSLF's case, you're getting that tax-free regardless. There's maybe only a couple states that might tax it at the state level. Off the top of my head, I can't remember those states exactly. I think one might have been Mississippi or something like that for PSLF. But there's maybe a very, very small handful of states that charges state income tax on forgiven student loan debt. It's not many. And then for people going for IDR forgiveness, the big thing to know about that is if you're forgiven, if you were supposed to be forgiven in 2025, even if you've received forgiveness later, you're not going to get a 1099-C with that. You're not going to get hit with a tax consequence of those loans being forgiven. But unfortunately, what that also says is in tax year 2026, if you get your student loans forgiven in 2026 and you were supposed to have them forgiven in 2026, that means the old treatment of student loan forgiveness for people in the private sector is coming back. And what does that look like? What it looks like is you're going to get a 1099-C miscellaneous income, basically in the mail from your servicer, most likely. And it's going to say your loans were forgiven or paid off. And then because they were forgiven, taxable debt that's forgiven is considered taxable income under IRS code. So you're going to get a 1099 in the mail. Let's say you've got 200,000 of loans, you get forgiveness in 2026, and you're supposed to be forgiven in 2026, not 2025. That you're going to get a 1099-C in the mail for 200 grand. And what they're going to do is they're going to look at your assets. They're going to say, are your assets greater than your debt? And to the extent that the assets are much greater than your debt, you're going to get billed on the forgiven debt as if it's income. Now, the good news is if somebody is really not in a good financial spot, if they have a negative net worth, for example, you just file a form to declare that you're insolvent and there's an insolvency exclusion, meaning that you don't get taxed on that debt if you have a negative net worth when you get forgiveness. Now, is it good to have a negative net worth to, get your loans forgiven tax-free? No, right? That's not what we want for people. What we want for people is to have a very large asset base so that when their debt is forgiven, if they do have to pay taxes on it, it's easy to pay. And what that's going to mean is you're going to want to be putting money aside, ideally into a brokerage account, a taxable account. And that brokerage account is something that you can manage on your own, or you can have a firm like SLP Wealth manage it for you if you're a financial planning client. And then that brokerage account, eventually you want it to be large enough where you'll be able to easily pull money out with smart cost basis, right? So you're pulling out stuff that's got the best cost basis when you sell, and then just write the lump sum for whatever it is. Now, are there ways to reduce that tax liability even further? Yes, there are, but keep in mind, you don't want to just have a lower tax liability, but also have much lower income. That doesn't make any sense. So, for example, if you could, quit your job in the year of forgiveness and then go live abroad for a year or work, quote unquote, work abroad for a year, there's something called the foreign income exclusion where, any income you earn abroad is not subject to U.S. taxes, which would probably put you in a lower tax bracket on any forgiven debt. So, for example, let's say you are a veterinarian, you're in, where I live in North Carolina, you're making 150 grand a year, and then you decide, you know what, I've always wanted to, be closer to my long lost love in Australia. I'm going to go there and move there, and I'm going to make 100,000 a year. Well, that income would not be subject to U.S. taxes in Australia. It would be subject to Australian taxes. But let's say you work in Australia for a year and you get your loans forgiven. You have 200,000 that's forgiven in Australia. Well, now you're filling up all your tax brackets with, basically brackets with the 200K is filling all those tax brackets that would have already been filled up from your 150K. So since we have a progressive income tax system, your 200K would be subject to a lower tax hit if you were a foreign citizen in the year of forgiveness. Now, or foreign resident in the year of forgiveness. Now, does that mean you should go find an Australian boyfriend or girlfriend and move there? There might be reasons besides financial and student loan that you would do that, but not really for student loans because you are going to make more in the U.S. You will probably, it probably doesn't make sense from a pure financial perspective to go flee the country because of your student loans or your student loan tax bomb. Now, some people might say, well, maybe I should go become a professional real estate investor and I should, buy a short-term rental and I should get a bonus depreciation, or I should buy a new truck and write it off through my company and, write off a ton of income that way. Is that something that you can do? I mean, the answer is talk to your tax professional. There might be some ways that you could reduce drastically your taxable income in the year of forgiveness. Does that help you? Well, if you go buy an $80,000 truck and you don't really have much of a need for it, it doesn't matter that it's reducing your tax liability. Even if you save 50% on that truck you're writing off, you're still spending $40,000. Same thing for, an Airbnb, you do some sort of bonus depreciation on. If you're only renting it out for 20% of the year, you're dumping a bunch of money into it and you're not an expert and you're renovating without being an expert, it's a lot more likely that you would blow your finances up than if you would save a ton of money in taxes, and make a profit on the Airbnb if you're not experienced. So I think that the key thing here is paying the tax liability is not the worst thing in the world, because hopefully you have time to prepare for it. If you are not doing tax loss harvesting with your brokerage account investing, SLP Wealth is a firm that could do that for you. There's other places out there as well. That's just one thing, though, of many. When you're thinking about a holistic investing plan, you want a place that's going to be not just doing intra account management, but inter account management. What that means is, like, are you paying attention to all of the investments when you're doing tax loss harvesting to avoid wash sales? Robo-advisor, if you don't tell them about a retirement account that you have, is not going to be doing that. If are you paying attention to your cost basis? So, most people that, it's interesting to me, whenever somebody's really confidently DIY, I ask them, what is your cost basis at Vanguard? And usually they tell me, I've never changed it. I'm like, okay. So what that means is the Vanguard cost basis is average cost for mutual funds and first in, first out for ETFs and stocks. So if you go sell money for a tax bomb, for example, you're going to, let's say you're doing average cost, you're going to realize thousands or tens of thousands in unnecessary taxes that you could have avoided. And the way you could have avoided them is to just literally choose the shares you sell, to have shares chosen that have lower gains that were probably more recently purchased to mitigate the tax hit you pay on gains when you go and sell. And if you do taxless harvesting over time, if you do realize gains, then hopefully you would have, some big losses on paper that you could use to write off against your gains. So, for example, my wife and I are thinking about getting a vacation home. I've been taking advantage of the fact that I've been doing taxless harvesting for years to write off gains that I'm realizing to build up cash for the vacation home, writing off those gains against the losses that I've accumulated. So that's a little bit of an investment technical kind of thing to end on, but I just am mentioning this because tax-free forgiveness is something that you should value, but you shouldn't overvalue it. And you shouldn't cause tax-free forgiveness to get you to do things in your life that aren't smart and, or not optimal, not what you want in your life. You should make the life drive the loan strategy and not the other way around. You don't want your loans driving your life. That's not what you want. That's not why we do what we do, to try to make sure people have the confidence to live great lives, regardless of how much student loan debt they've got. So thank you so much for listening to the Student Loan Planner podcast. If you want to ask a voicemail question like the people who asked them today, studentloanplanner.com/voicemail is the spot to do that. And if you want a one-off engagement, the student loan consult is a great service for that. So studentloanplanner.com/book. And if you want all-inclusive management of everything you've got going on, our registered investment advisor firm, SLP Wealth, that's registered with SEC, is a good option, I think, as well. And that's just slpwealth.com. You'll see the sign up button on slpwealth.com. So it's pretty straightforward there if you want to give that a try. I think that service is making the biggest changes in lives of what we do. So excited to be able to share this weekly episode with you. Thank you for listening to the Student Loan Planner podcast. I hope you have a great rest of your week.